Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Stephen Auth of Federated Hermes writing this: "We remain optimistic. This season has been exceptionally positive, with earnings running 8% year over year and upward revisions running higher than usual." Stephen joins us now. Stephen, wonderful to see you. Thank you so much for coming back. You're right. Earnings have been surprising to the upside. Why are stock traders not necessarily impressed?
Lisa, could you repeat that again? You're right. I love that.
Okay, all right. You're right, Stephen. This sounds like a home squabble. Stephen, you're right. So carry on.
Lisa, these stocks have had big run. Like, look at Disney. It's almost doubled over the last year. A lot of these stocks have run into earnings. And so, traders are taking profit. That's pretty normal, actually. And we tend not, obviously, we're too big to trade the day. We don't really do that. But we look at the longer term picture, the next 12 months, we see a broad rotation out into everything else. You're starting to see it already. Disney's not like on our buy list per se, but it's one of those stocks that probably is going to participate in that rotation, right? It's relatively inexpensive. It's really been in a doghouse for a long time. It's starting to come to life. It's got a long way to go to get back to where it used to be 3-4 years ago.
So the numbers allow people who like to spin narratives to spin them in any which way they want to. And so it's kind of a field day for people who have lots of creativity and some time to do so. I am curious, if you do look at the earnings, it does look like any mention of uncertainty is punished at a time where there's a lot of uncertainty. And some of the economic data has pointed to a potential stagflationary type of mix that definitely surprised markets. So which is it? Are people responding to that and penalizing that? Have people recognized those risks in valuations?
Well, I mean, the overall market's really not that expensive. Once you take out the Mag 7, which are kind of special, exceptional companies globally, right? You take them out, the rest of the market's trading around 19, 20 times. We don't think that's an unreasonable level, and we think it's the rest of the market where there's value right now in the market. So, I would call it's an environment where there's short-term uncertainty and long-term less uncertainty. I mean, if you look at the pattern of what's happening right now, as an example, when I was on a few months ago, we were talking about this. The soft data is signaling a slowdown. The hard data is still good. When is it going to catch up? The hard data, by virtue of the fact that it's hard, is rear-view mirror stuff. It's what the Fed uses, as an example. I call it the cracked rearview mirror. We're in a news cycle here that's 24/7 now, more than ever. Trying to make forecasts based on hard data you're fighting yesterday's war. So the Fed is now coming around because the hard data is finally softening up. We've been screaming that they should be cutting way back in the spring. They're now going to do that. We're entering a cutting cycle. But the soft data is starting to turn. Look at things like air travel. Boom, it's spiking. The Dallas Fed's real-time economic indicators, it's up 100 basis points in the last month. You look at consumer sentiment surveys, up 10 points in the last couple of months. You got small business confidence indicators up 10% the last couple of months. You look at the market and the industrials, the cyclicals are starting to lead. We do a lot of IPOs at Federated Hermes, right? I'm teasing the guys in the office. I've become the office receptionist after 5 p.m. I mean, I get these companies all showing up.
But Stephen,
right? I mean, that market has really picked up. That's not a sign that confidence is falling over amongst the people that actually make decisions in the economy. So we see all the soft indicators picking here, most of them. And, we're pretty optimistic, as you know. About
For all that good news, though, what's been pricing in is the uncertainty of tariffs. They're actually going to bite, and we're going to have an average tariff rate about 15 to 20%. This time last year, it was 2.5%.
Yeah, I think you got to check the math on that, because the actual, remember, that a lot of the goods that come into the U.S. come through Canada and Mexico. The goods that come in there through USMCA are 0%. Mm-hmm. So when Trump talks about these massive tariffs on Canada, Mexico, he's talking about trade that they've brought across the border that doesn't conform with USMCA, which in the case of Europe, if they were doing that, they'd throw them out of the Union. So you've got to account for that zero part of the thing. The actual tariff rate on average right now, as we know it, is about 13%. We figure about half of that's going to be paid by the foreign importers. So you're looking at 15% of the economy's imports. Half of that is not going to be. You work out the math. It's about an 80 or 90 basis point price increase, probably spread over 6 months. There's all these other things that are decreasing in price: commodities, steel, oil, regulatory costs, taxes. Another way to think about what Trump is doing here is he's increasing a consumption tax, a pretty efficient one, by the way, because it's partly paid by foreigners. And he's using it to fund an investment tax reduction with all these accelerated. The multiplier on investment spending is multiples of what it is on consumption spending. So there's a kind of shift going on in the economy. I get the tariff thing is not that positive, but it's not as big of a deal. It's the one thing everyone can hang on to, so it's a good discussion point.
You mentioned the president a few times. He thinks you have great analysis, by the way, because I follow his Truth Social, and he has tweeted about you. Right now, he has what some would say undermined market credibility when it comes to hard data releases by firing the commissioner at the BLS, continually going after the Fed, and some are saying maybe it's going to be very overtly political individual he'll put at the Fed. Do you think he's undermining market confidence?
A little bit. My advice to him, not that he takes my advice, but I don't think it's necessary to pound the Fed chair. As an example, on that case, I would just say, look, the Fed chair is a rear-view mirror-looking guy. He simply is going, stop listening to what he says he's going to do and just think about what he's likely to do. And we've been saying for a while he's going to start cutting in September. Now that the rear-view mirror is looking like it should, he will. On the labor secretary, one reason that storm has passed, and I don't necessarily agree with the pressure there either, but one reason that storm has passed is because the reality is, let's face it, I've heard you complain on the air about the labor numbers. They've been terrible.
They have been.
There needs to be an overhaul of that department.
Well, there's a hiring freeze right now.
If he had positioned it from that perspective, it probably would have not even been a news story. But at the end of the day, people are saying, yeah, the labor numbers aren't really good. Yeah, the Fed, no, they've been a lot of bad calls here. So he's not completely off base with the pressure in these areas.
How concerned are you about inflation, given the fact that right now you look at backward-looking numbers that might constrain the economy, but the forward look is pretty rosy at a time where you do have some input pressures with prices?
Yeah. But the Fed's not looking forward, so I think they're going to cut.
So that's fine.
And the other thing is that, I look at the actual ongoing inflation rate here. It's kind of stabilizing around 2.5, it's right at 2.6, 2.7, but it's going to stabilize by next year, 2.5. That's really the Fed's informal target. I think they figured out a long time ago 2 is too close to 0 for government work. So assuming that, right? Shouldn't the Fed funds rate, if you look at history, should be about 50 basis points above that. That's 3. So we have Fed funds going to 3 over the next 18 months. I think that's where we're heading here. And so I would just say I got 6 cuts coming against a backdrop that's pretty good. We have the Fed cutting not because they need to, but because they can. And now that they think they need to, they'll start doing it. And once they realize they can, they will.
Stephen Auth, he is the receptionist at Federated Hermes, where he offers lots of pigs in a blanket. Do you have your different snacks?
Water, tea.
Yeah, exactly. Stephen Auth, the CIO of Equities at Federated Hermes. Thank you. Turning back to markets, we are seeing stocks looking through all of this, looking to rebound after the S&P 500 posted its 5th down day in the last 6. Anastasia Amoroso of Partners Group writing this. This is a long-awaited quarter of adjustment, and the market may need to act accordingly, expecting less upside and more choppiness in Q3. Anastasia joins us now. Great to see you. Thank you for being here.
Good morning, Lisa.
All right, so this is the adjustment that everyone is expecting, that everyone's looking to buy into. How do you get an adjustment? And I asked this question yesterday. How do you get a sell-off if everyone's looking to buy the dip?
Well, I think the news flow is going to dictate that. And we need to have more Caterpillar-like reports that talk about the tariff hit that some of these companies are going to have to absorb. And some of that may be in line with consensus expectations, and some of it may not. I think that could be one trigger for a potential pullback as we really do realize the tariff hit. The other trigger, of course, is inflation. And inflation expectations for next week are somewhat subdued, but could we see some potential surprises there? So, maybe, Lisa, the move here in the market is not necessarily tremendous downside, because I think some level of expectations already baked in. But that's why I really kind of call it the quarter of choppiness, because on the one hand, we need to mark to market some of these tariffs. And at the same time, we also know that if the labor market weakens as a result of that, then that sets us up for a September cut. And I think that's what the markets are caught in between. And that's why we sort of get the back-to-back days of selling and buying and selling and buying. And I think that could continue.
And that's the reason why you're seeing some selling, even on the heels of earnings reports that are really positive, which we've seen increases to forecasts that beat expectations, and then the likes of AMD selling off. I'm just wondering, what do you do with the chop?
Well, I think for public market investors, if you have any sort of pullback, of course, you step in and you sort of buy your favorite names. And I would say, for us, it's really about long-term investing at Partners Group and focusing on thematic investing and really aligning yourself with some of the key secular growth themes. As much as we worry about the next inflation report or the next, rate cut or not, what truly determines whether the company is going to outperform or not is whether it's aligned with a long-term trend of, let's say, artificial intelligence or perhaps healthcare innovation or new way of living, and whether you align with that and benefiting from that. So, if there is an opportunity to buy into that in public markets, that's great. For us, I think there's a lot of deal activity that we're looking at, and given the clarity of tariffs that is emerging, I think for the private equity industry in general, the deal activity is likely to pick up.
Is it the clarity because the rates are set? Or is it the clarity that they're not as bad as some would expect?
Both. I mean, Anne-Marie, we put this chart together, looking at the percent of world GDP that had a deal in place. Back in April, it was zero. Nobody had a trade deal done with the United States. And today, you fast forward to today, and about 30%, about 28% of the world GDP has some sort of a deal in place. And there's still a big chunk of global GDP that's in negotiation. So that's the first point, is that, you have predictability, you have some clarity for a growing share of GDP. The second point is the one you made, which is, for most countries that are able to negotiate a deal, they're doing so at a lower tariff rate that could have been under the Liberation Day announcement. So I think it's both of those things. And then the third point is, now that we have the numbers, now that we have the certainty, we actually know how to price things. And this is why I say some of the deal activity can also move from being contemplated to actually being materialized, because we know exactly what we have to pencil into the models.
But what happens when the higher rates, which is a much higher average rate than we had last year, actually starts to get digested in this economy? 2.5% versus 15%, 20%, depending on the country.
Right. Well, that's why I call this a quarter of adjustment, and it's going to happen this quarter. If you think about, for example, the tariffs that were back in April, about 3%. Now the tariffs have ratcheted up closer to 10%, and I think most of that is being collected now. And in the next month or two, we're going to see 15 or 16% that's collected. But one thing that I will refer back to the Caterpillar report that I found interesting, they very much talk about profit margins, including the tariff hit, but also profit margins excluding the tariff hit. And that really suggests to me that companies, as well as the Fed, are treating this as a one-off adjustment that they need to take and they need to process. And I think it happens in Q3.
As you see the pipeline of opportunities in the private markets really build steam, you buying into OpenAI at $500 billion?
I will defer to our investment teams on that. But, I think valuation is something we take very seriously. And look, I will say, Lisa, broadly speaking, in private markets, it's where can we find the most robust margins and where can we find the fastest growth rate and EPS, and how can we actually build that? That's what we're focused on.
Building rather than maybe buying into after the fact to give $100 million bonuses to all the people to have them stay in place. Although that might be the benefit for some of these strategies. Anastasia Amoroso, Partners Group, thank you. Wonderful to see you, as always. Frank Lee of HSBC has a buy rating on the stock and a price target of $200 from the current $163, noting a bullish AI tone and need for higher conviction to drive earnings upside. Frank joins us now for more. Frank, thank you so much for being with us. How frustrating is it to get the fundamental story right and the price action wrong?
Yeah, that's a good question. I think when you think about this, though, it was just really about the conviction that the management needed to give people. We had a really strong run-up into results. So I think going into these results, people were looking not only for a good number, but something tangible for analysts to be able to raise their numbers significantly after these results. And I don't think we got that. So I think that was why the shares didn't react so well. And I think the other point was China as well. There was a lot of expectations built into that the MI308 would come back, but it also shows you the complexities of the China-U.S. relationship. So I think now people are going to have to take a step back and look at whether or not how quickly these licenses can come and how quickly these revenues can come. But again, I think the market is over-focusing a bit on it because if you look at the fundamentals, there's a lot of growth still in the hyperscalers. That's more than enough to go around to drive their growth.
So are investors just sort of looking for certainty where there is none? Are the outperformers right now just giving false promises of hope? Or are you saying that essentially there are some companies that are more fortified against some of these uncertainties and are getting rewarded for that, and these others are sort of in a wait-and-see mode from a stock performance standpoint?
Yeah, so I think, the China element certainly has become a big part of the narrative this year, not only for AMD, but also for NVIDIA. So I think that has complicated the AI story a bit. In a way, I think, that the expectations are probably a bit more bullish on that. But we also believe, though, that you don't quite need the China story for this to play out. I mean, we still see very strong demand. They highlight on the call that the MI355 is doing very well, better than expected, and the pricing outlook is better. So we do think that it can continue to work, but I think the narrative has been a little bit too narrowly focused on the China part, and we've come to a realization that it's not going to be as easy for China revenues to come back in as people previously expected.
If we could sit on China for a second, why is it so much harder for AMD than NVIDIA?
Well, we haven't seen the NVIDIA numbers yet, so I guess over the next month we'll see how much the NVIDIA add back comes back from China. I think AMD did disappoint in the fact that they haven't started their revenues. We do expect. I think NVIDIA had more inventory on hand that they could probably ship out. You also saw that AMD had a lot of work in progress inventory, so that has to be resumed. So that's going to take a bit longer versus what we saw potentially for NVIDIA, which had already built up finished good inventory.
But NVIDIA has been, at least when it comes to the rhetoric, very bullish on getting back into China. Actually, we learned of the Trump administration's U-turn on these export controls because Jensen Huang was in Beijing and NVIDIA released a statement that they're going to put the H20s back in the Chinese market. So would you say they are months ahead of where AMD is?
I think they, like I said earlier, I think the way their product has been built out, they've already shipped out a lot more chips. So I think they are in that sense ahead. Whereas, AMD has admitted that they have a lot of these products are still in the building phase. So that's why it's going to take longer, as well as waiting for the licenses. So I think that's probably one of the reasons why you see, a stronger recovery for NVIDIA from the China part.
Frank, we hear a lot of noise about tariffs and ongoing discussions that are happening right now. The President of the United States has talked about semiconductor tariffs that could go on as soon as this week. How much is that already factored into a lot of the earnings? How much noise is there and how much signal?
Yeah, so I think the semiconductor tariff is definitely something that has been on people's minds. I think for the most part, if you see a tariff that's less than 20%, I think the market will take that quite well. But it could be a lot higher than that. I think it's going to hit the actual chip makers like TSMC a lot harder. I think the companies that are leveraged to the hyperscaler growth, I think can pass on some of these prices increases more effectively as the hyperscalers have a lot bigger CapEx budgets and continue to raise them. So I think it's going to hit the consumer part of this semiconductor pie a lot harder than it's going to be on the AI side.
Frank, what about some of these proposals to put tracking devices in certain high caliber chips, as well as some of the constraints without constraining the supply of chips? I'm really trying to wrap my head around what the administration is trying to do to keep the flow of commerce while clamping down on some of the more sensitive chips. Do you have a sense of how this is coming together, of what this proposal looks like?
I think it's still very difficult to have an idea of how it's going to end up. But remember, this also isn't entirely one-sided. We've had some chatter last week of China having some concerns about the NVIDIA chips as well, in terms of whether there's kind of a kill switch. So I think there's going to be a lot of back and forth when it comes to this. So I think for most people that look at the AI story, we should continue to look at outside China as an area of growth, right? I know the narrative continues to be on China, but if you look at, what's really doing well, basically, the AI companies, these chips are doing fine without the China market. I know people would like the China market, but if you take out the China market, these guys are still growing, and I think for the most part, still beating expectations.
Frank Lee of HSBC, thank you so much, as always, for your insights. Joining us now is Rich Greenfield of Lightshed Partners. Rich, before we get into the nitty-gritty, why are shares lower after what Geetha just described was a pretty blowout report?
I mean, I think you got to sort of step back. First of all, I think blowout might be a strong word. I think the reality is Disney stock has obviously had a nice little run over the course of the last 6 months. I think the company definitely, I don't want to say was sandbagging, but, if you listen to Hugh Johnson, Disney's CFO, he certainly was keeping, he didn't raise expectations after last quarter's pretty meaningful, upside in the first, several quarters of the year. So I think there was sort of an expectation that this was going to be good, that they were going to exceed expectations and raise the guidance. And so I think it was sort of in the stock. So I think this has been a very widely owned stock. People were sort of knew that the outperformance was coming. And I think the reality is, I think the thing that surprises me is that there isn't more excitement around the WWE deal this morning or the NFL deal. But I think just sort of the, hitting what people have thought, and you're sort of seeing sell on the news more than anything else.
Well, the market initially really did like that deal when it comes to ESPN and the NFL media. What does this say to you about the direction of travel for Disney and the company writ large? Is that going to be a spinoff, Rich?
Well, look, I think that you got to step back. And so, the stock is trading, you've got it up on the screen right now, $115. If you go back 10 years ago, Disney reported their fiscal, Q3 earnings. The same week, 10 years ago, the stock was trading at this exact same level. So this has been sort of a lost decade for Disney in terms of the stock. Yes, it's been up and down in between, but 10 years it hasn't performed. I think it's really setting the stage for a strategic transformation. And, Iger's last year is 2026. And I think when you look at how they're positioning ESPN, if you think about sort of launching the direct-to-consumer service, having it stand on its own, adding in the NFL content, doing the big NBA deal, this morning doing the WWE WrestleMania deal, they are putting all of the pieces together to separate ESPN and probably ESPN and ABC from the rest of the Walt Disney Company at some point over the next 12 to 18 months. And I think that is going to be the next strategic catalyst for Disney. I don't know. I don't think they'll talk about it this morning, but it feels like they're setting the stage for that.
Does Bob Iger want that before he exits the company? And by the way, we should note expectations he's going to exit. Some think maybe he's going to stay on.
Look, I have no insight into whether Bob actually leaves. He certainly has been telling everyone that is close to him that he's really leaving this time. The chairman of the board, Gorman, is certainly tasked with finding a replacement. I think you're going to see that replacement. And, look, I think Disney has two core challenges. Figuring out the future. If you think about youth culture, my partner, Brandon Ross, has been writing about sort of the incredible surge of engagement around Roblox. Like, if you look at where youth culture is and where kids are spending their time, it's hard not to look at something like Roblox and go, how is Disney not in this world? Like, sure, they're building something on Fortnite, but if you look at sort of the UGC growth that's happening so organically on Roblox, like, that seems more like where Disney should be than trying to figure out the future of sports streaming with ESPN and ABC. And so I think sort of whoever is Disney's CEO, I think the big task is figuring out what is the future mix of this company? What is the ideal mix of assets to be positioned so that the next decade looks a lot better than the last decade?
There's also a question of the geographic footprint, Rich. I mean, we're seeing AMD shares fall because of a lack of certainty with China, but we understand that Disney has its footprints in China as well as around the world, even though some people might see it as sort of brand Americana. How much does that threaten, or how much do you want to hear about that on today's call?
I mean, look, I think a topic that people don't really like to talk about, right, is how are U.S. movies performing overseas? And I think if you look at a lot of the international performance, you're seeing it be relatively underwhelming. And, I do scratch my head and wonder whether there is sort of a greater sort of anti-American sentiment. Certainly China has boxed almost, even if they let U.S. movies in, they don't do any box office anymore. And so I do think that there is this growing fear I have around Hollywood and the movie exhibition business, that international, which used to be sort of the huge upside for these films, like you did a good number in the US and then you blew it out overseas, we're seeing a lot of underperformance overseas that is increasingly concerning.
Rich, I'm just wondering, looking forward, the other thing that we've heard in terms of a theme from companies has been artificial intelligence. And I know that Disney and other content creators have really not wanted to talk about this because of the strikes in Hollywood and some of the other concerns around what this will do to jobs. But is that going to be something that you expect to hear about, given that it's kind of a tool that they will need to be using?
I think everyone in Hollywood is going to initially look to how do they use this to speed up creation and reduce cost. The challenge is going to be not so much how a company like Disney or Warner Brothers Discovery or Paramount uses these tools, but how the kid in their basement, who never could have created a feature film before, now can. Like, will somebody come up with Bluey in their basement, right? Like, just using all of these powerful tools. If you're a good storyteller, you don't have to be a good animator anymore. AI can do that for you. And so I think what's going to be really interesting as you look forward is how the competition or the competitive landscape, not just for Disney, but for all these media companies, changes over the course of probably the next 3 to 5 years. I mean, the pace of AI innovation is astounding. And I think what you can do is only getting cheaper and faster and easier. And so the competitive dynamic that, that currently exists, there aren't many companies that do feature-length animation. I wonder in 5 years how we're going to think about the competitive set for animation.
Rich Greenfield of Lightshed Partners, thank you so much for being with us today.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.